We are covering equity valuation methods for the Series 65 exam. The exam will not require you to perform complex calculations, but it absolutely expects you to understand the concepts behind the numbers. Let's start with the big picture: fundamental versus technical analysis. Fundamental analysis is like being a detective for a business. You're examining the company's financial health by looking at its balance sheet, income statement, earnings, and management. The goal is to determine the company's intrinsic value, which is what the business is truly worth, separate from its current stock price. Technical analysis, on the other hand, is like being a weather forecaster for the stock market. You don't care about the company's financials. You're looking at charts, price trends, and trading volumes to predict future price movements. The exam trap here is to think one is definitively better than the other. NASA's view is that both exist, both have uncertainty, and any claim that a method guarantees a profit is always a wrong answer. Now let's zoom in on the tools of fundamental analysis. The price-to-earnings, or PE ratio, is a classic. It compares the company's stock price to its earnings per share. A high PE might suggest a stock is overvalued or that investors expect high future growth, which is typical for growth companies. A low PE might indicate an undervalued stock, often seen with more mature value companies. But the PE ratio has a blind spot. It doesn't account for growth. That's where the PEG ratio comes in. The price-earnings to growth ratio takes the PE ratio and divides it by the earnings growth rate. This is a critical exam concept. If you have two companies with the same PE ratio, the one with the higher earnings growth is more attractive, and the PEG ratio will highlight this by being lower. A common exam question will present a scenario where a stock looks expensive based on its PE, but is actually a better value when you factor in its growth using the PEG ratio. Another key valuation tool is the dividend discount model. This model values a stock by calculating the present value of all its future dividend payments. The core idea is that a stock is worth the sum of its future income stream, discounted back to today's dollars. The exam won't make you do the complex math, but you need to know that if you expect dividends to grow, the stock's valuation will be higher. Be careful with trick questions that apply the dividend discount model to a company that doesn't pay dividends. In that case, the model is useless. Finally, we have book value, which is essentially the company's net worth from an accounting perspective. The price-to-book ratio compares the market price to this accounting value. A low price-to-book ratio can signal an undervalued company. The exam may try to confuse you by including intangible assets like goodwill in a calculation. For the exam, you should generally focus on tangible book value. A great way to remember the core difference between the two main analysis schools is this mnemonic: fundamentals tell you what to buy, technicals tell you when to buy. Fundamental analysis seeks to find quality companies by looking at their intrinsic health, while technical analysis tries to time the market by looking at price action. The Series 65 tests your understanding of these concepts to ensure you can properly assess securities, not just chase performance. You must know which tool is appropriate for which situation, and most importantly, understand the limitations and risks of each method. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.